Profit first, and really everything that I teach my clients, whether it's personal finance or business finance, it's really about cash flow. And this isn't one of those cash is king sort of stories, although in a lot of ways I think cash is king. It's really more about making sure that you understand your flows. When is stuff coming in and when does stuff have to go out? Hi everyone, it's Tina with Picture It Personal Finance, where I teach entrepreneurially minded people how to win with money, both in their personal and in their business lives. Today, I want to introduce some of you to the Profit First methodology. Profit First came out in a book by Michael Michalowicz. I'm not sure what year it came out, but I will link to the book in the description box below because it is really a game changer for many business owners. And I feel really fortunate that I stumbled across it when I was just starting to get clients. So I have been a profit first business essentially from the start. I will admit that I tried to do it in a more abstract way off of spreadsheets to begin with and using YNAB. In the end, though, I gotta be honest with you guys, just doing it how the book explains with the multitude of accounts really is so much simpler. It was so much easier to keep things straight. So that's what I recommend to my clients to do versus doing it in the abstract way. But for full disclosure, I will tell you both ways work. So what exactly am I talking about? I will begin by saying, going back to that original equation, that your sales or revenue minus your expenses equals your profit. What ultimately Michael Michalowicz in the Profit First book is telling you to do is instead, so that you can ensure through your profit that you are able to pay for your own owner's pay, what you ultimately do is you flip that equation so that you now have sales minus profit equals expenses. So in other words, you take your profit and you pay yourself first out of your revenues, and then what's left over becomes a sort of boundary for what you can use for expenses. This is really important for business owners who are in this sort of like, I have to scale, I have to grow phase of business, and they just reinvest everything, or they never really had a truly viable business to begin with, because essentially they built a business that all of the revenue has to go into the expenses in order for the business to survive, leaving them no room to take owner's pay. In that situation, I would argue it's actually not a viable business. You have to be able to take pay. A business is designed and meant to give value not just to your client base, but also to you as the business owner. You have all of this risk. You must also have reward. And if you do not take any reward out of the business, frankly, it's like having a ship with no captain. You will burn yourself out. You need to build in cushion to pay yourself, as well as, time management cushion. I mean, we know that there's three core resources: your health, your energy, your time. I screwed that up, didn't I? You have three core resources: your health and energy, your time, and your money. If any one of those are not sufficiently supported or fulfilled in your life, you're going to suffer, and therefore your business must pay you consistently. You need to be able to earn money out of your business, or you're not going to be able to sustain that business. Profit First gives you a methodology for doing this. It essentially says, first and foremost, pay yourself, which ironically is one of the core tenets of personal finance. How often do you hear, if you pay yourself first out of your money, you'll never know that it's missing? Like auto pay your 401ks or auto pay to your retirement account, set up these auto transfers, pay yourself, set your savings, get that done first. And then with what's left over, you have your living expenses, your fund money, things to that effect. Essentially, he's applying that exact same concept to your business. Figure out what your business needs for profit reinvestment or profit sharing, and figure out what your business needs for owner's pay, and then decide what's permitted for your expenses. Having said all of that, the book goes into so much more than just explaining this philosophy. It actually gives you a system of 5 bank accounts plus. You could have more than 5 bank accounts, and some of my clients do have more than 5 bank accounts. As a matter of fact, I myself have more than 5 bank accounts, but you need to have a minimum of 5. The first account is going to be your income account. The income account is essentially where all of your monies that you earn, your incoming revenue, will get pushed into that account. For me in particular, I have money coming from QuickBooks Online payments going into there. I have money from PayPal going into there, and I have money from Venmo going into there. Whatever payment system you're using, make sure that it deposits the money into the income account. Then twice a month, you will do what's called the profit first transfers into the other accounts. Those other accounts will include your profit account. This is an account that is ultimately going to be used for reinvestment into the business or for paying quarterly bonuses to you or other owners. It could be part of you could use it for profit sharing with employees of the company if you've got a larger small business, or for example, with myself, I'm a solopreneur. I take it as a quarterly bonus or a semi-annual bonus depending on how much money is in the account. The next account is your owner's pay account. This account is where you will take a percentage of the income that comes in and you will just put it into this account, and we'll talk a little bit more. Actually, I have another video that I did a little while ago where I explained how to use that owner's pay account. From there, you pay yourself, but you don't empty the account every time you pay yourself. You pay yourself according to what you need to sustain your lifestyle. So I will put a link to that video also, so that if you're struggling with paying yourself consistently and mimicking a paycheck, that can give you some information that will be useful to you. After that, you have your taxes account. And your taxes account, in the book, it says to go and deposit 15% of all your revenue into that account. I think that's a pretty consistent number that many accountants will support. I am a single member LLC myself. I put in 25%. I figure I would rather have more money in that account than I need and then take the excess as an additional bonus to myself around tax season than risk having an insufficient amount to pay my taxes. So that is a separate account. Now, I will tell you that you can pull from that account to pay your taxes on the monthly or the quarterly cycle if you're doing quarterly estimates, for example. I haven't grown my business to that point yet, so I am still only paying taxes one time a year, but I will need to shift to the quarterly taxes going forward. It still comes out of the same account. I fund that account and I pay out of that account specifically for taxes. And then the last account is your operating expense account, or your OPEX account. The remaining money that's in the income account after you've funded the profit, the taxes, and the owner's pay accounts, anything left over will go into your OPEX. It should be a particular percentage that we will talk about in just a moment. But really quickly, one more recap. There are 5 accounts you must have. That's going to be your income account to get the money. It's going to be your profit account to pay quarterly bonuses and reinvestment. It's going to be your owner's pay account to pay yourself. It's going to be your taxes account to pay, Uncle Sam. And then it's going to be your operating expense account to ensure that your business has the funds it needs in place to pay for your recurring expenses. Once you have all of those accounts in place, the book says twice a month to do these transfers, right? So all the money goes into that first income account, and then you will have decided ahead of time how much or what percentage of each of that incoming money do I want to allot to each of those other 4 accounts. Now, I will show you what he recommends in the book, and I'm going to pull up a spreadsheet for that. Here is the spreadsheet that I provide to my clients when we are building out their profit first review. As you can see, I start right up here at the top with the profit first version of that equation I was just speaking about, that revenue minus profit equals expenses. And the very first thing that we do is we talk about the current monthly personal expense that my client has. How much do they need to live off of? So in this example, the client requires $3,000 per month to live off of. I take that number and I apply it right here. So if, let's say, for example, it was $2,000 a month, you can see then it will change that client's revenue target. But because we know they need to have $3,000 a month, that is what I put in. The targets are dependent on, the revenue target is dependent on these percentage allocations that I had already decided on. As a matter of fact, now that I'm looking at this, these are very close to mine. The only difference is that I do 25% for taxes and 20% for OPEX. But essentially what I help my clients understand is once we know what your living requirements are, and once we also know what your allocation percentages are, we can calculate your monthly revenue targets. Some of this is done by using the instant assessment. This is a feature that is talked about in the book. I'm not really going to dig into that right now. However, I will tell you that by doing this instant assessment, you will be able to decide how close you are to the target allocation percentages. And when I'm talking about allocation percentages, just to be abundantly clear, I'm talking about when you have money go into the income account, what percentage of that will be allocated to the other accounts. So if you go by the target allocation percentages for the book, the author, says that of your revenue, 5% should go to profit, 50% should go to owner's pay, 15% to taxes, and 30% to operating expenses. And I also realized I have a typo right here. I'm going to fix that really quick or it's going to drive me crazy. These are your TAPs. This is what he's saying, is that if you make between 0 to 250,000 a year, you will have 5% to profit, 50% to owner's pay, 15% to tax, and 30% to operating expenses. You're not going to be there right away. You are going to have to get there over time. What we need to calculate for many of my clients is where are they today? And then part of it is we formulate a plan how to get them to these percentages or other percentages depending on how well they want to align with the book. But if you were curious what the book recommends, you have that right here. This is straight out of the book in terms of what his recommendations are. And then as I mentioned already, you have those accounts, and he is in the book, a very clear naming convention for the accounts. In the account nicknames, he would have you put the name of the account being, so income is the first one, and then profit would be the cap, so the percentage that you currently will send to profit. So maybe it's 1% or 0%. And then 5% is the target you want to work up to. Your owner's pay, let's say you're currently only paying yourself 5% of revenue, but you want to work your way up to 50%. That seems extreme, I'm sure, to some of you who are listening, but I promise you there are clients that I have seen or worked with, or individuals, I should say, because not all of them were clients, who really were barely paying themselves anything, like a pittance, and they needed to be working up toward 50%. Tax is another one where very few people set any money aside. And so again, your cap might be 0, might be 1%, might be 2%, but you want to be at least at 15%. And then operating expense for many people is very high. Anywhere from 60 to 80% of all of their revenue goes straight into expenditures for the business. And you want that to be lower, much lower. So in this example from the book, they would say that the target is 30%. But like I said, for me, I am a virtual bookkeeping professional and a financial coach. I really only have 20% of my money going into my operating expense account. Okay, so having showed you that spreadsheet, you now can see how there are the current allocations, which is where you are today. So you'll have to figure that out by doing your Profit First instant assessment. And for those of you who need help doing this, feel free to reach out to me. I do one-off sessions to just go through this Profit First stuff with people via a clarity session. Or if you're interested in going through my full program, I'll put a link to my website below so you can see what the pricing is for that. Once you know what your current allocation percentages are, that's ultimately what you're going to use, but you want to work toward those target allocation percentages that you saw from the book. So now we know that you are going to pay yourself first. We know what accounts you need for the Profit First system to function, and we know what are the percentages that you're going to transfer into those accounts so that you fund those accounts ahead of when you need to make your transfers to yourself. Ordinarily, people will need to decide what are the dates that are best for you. In the Profit First book, it does say to do your Profit First transfers on the 10th and 25th, and that is to correspond with payments on the 15th and on the 1st. This is what I do personally. However, it really could be contingent on what your business needs in particular. You may, for example, be a business that always issues invoices on the 15th with a 15-day pay period, like where you permit them 15 days to pay that invoice, and therefore you're getting a lot of your payments on the 30th. If you're getting your payments on the 30th, then maybe it would make more sense for you to do your profit first transfers on the 5th and on the 20th and pay yourself on the 10th and on the 30th or something like that. I mean, essentially, you really want to understand when your cash is flowing. Profit first, and really everything that I teach my clients, whether it's personal finance or business finance, it's really about cash flow. And this isn't one of those cash is king sort of stories, although in a lot of ways I think cash is king. It's really more about making sure that you understand your flows. When is stuff coming in and when does stuff have to go out? And using that, you can forecast for the future. Actually, the more I think about it, I think one of my future videos will be to do an operating expense forecast for you guys to show you how I build a cash flow budget for my clients and how we use that to forecast out for an entire year, and also how we identify some like red flags or when you need to beef up your revenue. Having said all of that, I really believe Profit First is a powerful system for you to put in place for your business. I hope you found this really informative, and probably the most difficult thing about Profit First is the transition into it. If you've already been in business for a long time, this is another thing that I work with my clients on, is helping them take a couple of months to get to the point where they're fully funding Profit First and using the Profit First system. You can't always just snap your fingers and put it into effect and get right to those target allocation percentages. You need to work yourself to that. So I help people do that, and I also help them understand the importance of habit change. And if you're interested in information about like habit change, you might like this other video that I'll present here in just a moment about how you can use habits to put yourself on autopilot and improve your life. Anyway, guys, that's all I have for you today. I hope you really enjoyed this video, and I'll see you in the next one.